Hello, can you hear me?
I'm able to hear you.
Hello.
Yeah, is my voice audible? Yeah, I am able to hear you.
Yes. Yes. Okay. I'll just share the PPT as well. I mean, just to see if. Uh,
Mhm. Yes, it's coming.
it's coming, right?
Yes, ma'am.
Okay. 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 I think it will start around 5 o'clock, right?
No, no, 4 o'clock,
Sorry,
4
4
o'clock.
o'clock. Yeah. Sorry, 4 o'clock. Yeah.
Mhm.
Is the
Okay,
PPT on a full screen?
no, it's not on full screen.
Now it's
It's
fine.
in now it's in full screen.
Okay. Okay.
Mhm.
Um, just a minute.
Uh,
Um,
mhm.
um, this is Sajag
Yes,
speaking
ma'am.
or
Yes, I'm Sajak speaking. Sajak Ved.
Sajag? Okay. My presentation would only be for half an hour or so, and then probably you will be taking it forward, right? Or how does it?
Ma'am, actually, means like content and all is more or less same only, like
It's the
basic
same.
introduction. Yeah, so in the past, whenever it happened, like either the means with SEBI, so like we give full time to SEBI people only, because then again it would be
Okay.
starting thing and all. But anyways, if you say something, like we can add over or something.
Okay. ठीक है. That is fine then. But please do add. I mean, if I have omitted things or if I have said something which is probably not uh, uh, the right thing, please feel free to intervene and correct what I'm saying.
Okay, okay, sure, ma'am, sure.
Okay.
Yeah,
And I
sure.
probably will not speak for 1 hour, so probably the whole thing will get over soon.
Okay, okay, okay.
And okay. I have a very, I think probably you are aware of SEBI presentation.
Yes, yes, yes.
Okay, because I haven't done this many times. I've just done it a couple of times before, and that too probably a few months earlier. You know. So,
Yeah,
okay.
even it is also for me also it's second time only. I guess last time Newton
Okay,
member.
cool. I think it is usually Luther ma'am who does it. Now she's no longer, I think, in the division. So probably that is the reason why they're allocating it to a lot of other people. That is fine. So it's,
Okay, okay. Yeah, but
yes.
actually, what I means like I was in one presentation, and what I have seen other people also whenever with SEBI, so like they give full time to SEBI only. So that's
Maybe.
why I was
Okay.
very yeah.
Okay, no problem. But okay, that's fine.
Mhm.
Okay, we start at 5, right?
No,
Sorry,
ma'am.
4. Sorry, 4.
Uh,
4, 4, 4.
yeah,
Yeah, sorry. Yeah.
yeah, we can keep the presentation on like after once it's 4 p.m. like we can wait for 1 or 2 minutes more because that is the time
Okay.
when people start rushing. So we can start 2 or 3 minutes post 4 p.m.
Should I stop sharing now or let it just be?
All up to you. Like I have no issues here.
Okay, so I'll just stop sharing, and once the whole thing starts, then we will start. Yeah,
Okay,
a couple
okay,
of more
okay.
minutes. Yeah. So,
Mm-hmm.
okay.
Okay. We will wait 2-3 minutes more, just waiting for a few more people to join. Shall we start the presentation in the meantime? Others who want to join will keep joining.
Okay, that's fine. I think it's just currently there are 10 participants, so we'll keep this whole thing short, brief. Yeah.
Okay, yeah.
Shall I start?
Yes, ma'am.
Okay. Very good afternoon to all the participants of this session. My name is Priza Kuryala. I'm from Securities and Exchange Board of India. I also have my colleague Sajak, who's from the NCTX Exchange. Today we are going to give a presentation on Indian commodity derivatives market. Before I get into the presentation, I would like to give you a brief about SEBI. Probably most of you are aware about RBI, who regulates the banking sector in India. Similarly, SEBI regulates the stock exchanges and the primary and secondary capital market. So SEBI is a statutory body and established in 1992 through an act of the Indian Parliament. We have three main functions or mandates. One is to regulate the securities market. Second is to protect the interest of investors. And third, to promote the development of securities market. Now, today we're going to talk about the commodity derivatives market. Now, before I go into the commodity derivatives market, let me say what is an equity market. An equity market is where we have companies mainly coming. We issue securities to raise the short and long. I request participants to mute their audio. So equity market is where we have companies issuing shares or securities to raise short and long-term capital for conducting their business operations. So a company may seek capital from an investor by issuing a bond. So a bond is a debt security. Similarly, the central and the state governments issue debt securities. Public sector companies which are owned by the government may also issue securities. The mutual funds issue units to investors to mobilize money, which is also a form of, coming into the market. So the securities market include equities, index futures, options, stock options, bonds, money market securities, REITs, real estate, investment trusts, etc. And the securities market also has two segments, the primary and the secondary market. The primary market, where the new issues come, which is also called the initial public offer, where the issuers or the companies raise capital by issuing securities to investors. That is for the first time when they come to the market. And once they issue the securities, and then these shares or securities are traded in the secondary market on the stock exchange platform. So that is where, for what we call a secondary market. So as an investor, you can either subscribe to the IPO, or you can buy the share once it is listed on the exchange platform, and you can start trading on the exchange platform. You can exit or enter the market. So today we're talking about commodity market. So what is a commodity market? Whereas equity refers to shares of companies that are traded on the stock exchange. In an equity, you have an ownership when you buy the shares of the company. Wherein in a commodity, it is a raw material. It could be an agricultural or it could be a non-agri product. And these are perishable or they have a validity. So there is no ownership per se, like how you get an ownership in a company. Now, an example of a commodity could be a sugar, wheat, coffee, or there could also be base metals like aluminum, copper. The commodity trades are shorter term and they're mainly focused on hedging your price risk. Wherein equity investments are usually made for a longer period of time with a focus on the ownership in the company. Now, otherwise, both are standard contracts as per the exchange platform. Like I said, commodity has an expiry date, wherein equity derivatives or equity shares, they are perpetual. And in commodities, again, you have four categories, wherein you have agricultural, precious metals, industrial metals, energy products. So these markets are usually used by industries, traders, importers, and exporters to hedge their commodity prices. Again, you have futures and options in commodity as well, like how you have stock futures and stock options. So the main benefit of a commodity platform is price discovery and risk management. So what does this mean? what is the benefit of going to a commodity exchange to buy a commodity, wherein you can buy the same thing in a wholesale market? The difference between a commodity exchange and a wholesale market is that an exchange creates a mechanism for price discovery. In the wholesale market, the prices are negotiated between the buyer and the seller, wherein on the exchange platform, we have many buyers and sellers across the country at any point in time. Now, these are participants. And when they come to the exchange, they place their bid or ask price. Bid is when you buy, and ask is when you want to sell. And these bid and ask price are based on their assessment of the demand and supply. And when the bid and ask price match, is there any doubt or any query? I can't hear anybody, any query. Is there anything? Okay. Sajad, am I audible?
Yeah, you're audible. Just like till now, no, nothing in even in chat box also on any queries as of
I
now.
just heard something. Okay. So like I said, on the exchange platform, we have many buyers and sellers across the country at any point in time. They place their bid and ask price on their assessment of demand and supply. And when the bid and the ask price match, a trade happens. And we say that the fair value of the commodity has emerged. And this results in price discovery. So that is why we say one of the main benefit of an exchange platform is that there is price discovery. So this is trading in its simplest form that I have explained. Now, what is a commodity and a commodity futures contract? Like I said, you can go to the market and you can buy a commodity. Wherein a futures contract is something which is traded on the exchange platform. You enter into an agreement to buy or sell a commodity at a specific price at some time in the future. For example, we can give an example of a farmer. A farmer has probably just a minute. A farmer has planted his wheat, and all through the growing season, he has long cash, meaning he, at the end of the season, he has to harvest and he has to sell his produce, meaning he has got wheat with him. So he owns the wheat. Now he hopes that the price he obtains at harvest pays back his production cost and his fertilizer, irrigation cost, etc. So, but he is not sure at the time of harvest he will get the price that is right now available. So he is exposed to the risk of the wheat price falling below the current price. To hedge against the falling price, the farmer can get into a futures contract right now and lock in today's price. So the important thing to remember here is that the farmer, who's a hedger in this case, who owns wheat, he has two positions. He owns in the cash market or in the wholesale market, he has got wheat, which is his own produce. And he is also entering into a contract in the futures market. And in the futures market, he is entering into a contract to, these positions are complementary. So one is long and the other, the position in the futures market is short. So these two positions are to offset losses in the other, insulating the farmer from the commodities volatility. So at the end of the harvest period, if the futures price or if the price at the time of harvest is lower than the price in which he has locked, he's benefiting from the futures contract. Wherein if he's getting better price in the wholesale market after the harvest, he can close out this particular contract and he can sell it in the wholesale market, his wheat at a higher price. So the contract is only to hedge his price risk. That is a futures contract. And mainly it is for hedgers. But we also have arbitrageurs and speculators also in the market as counterparties. So in both equity and derivatives, the underlying is standard. I mean, it is a standard contract which is offered, wherein in the commodity derivatives price, there is price opacity, meaning a wheat or any other commodity, say turmeric, the price of turmeric in the wholesale market of, say, Maharashtra might be different from the price of turmeric which is available in the market in Karnataka, wherein the price of an equity share is the same across India. That is why we say the underlying market is fragmented and there is price opacity. Again, underlying supply. For shares, we know that so many number of shares are issued. It is available in the public domain. So we do not know at the time of harvest, after the harvest, how much of turmeric is going to be available. Was the rainfall good enough that the turmeric crop has, is there sufficient supply, or is there damage of crops? So there is the estimate of supply is uncertain. In the equity derivatives market, it is a very, it's been there for quite a long time. So we have a lot of retail and institutional participation, wherein in the commodity market, we have mostly brokers, farmer producer organizations and traders, but the sophistication or level of participation is quite low. It is not mature enough like the equity derivatives market. Price sensitivity is very high because these are commodities that are actually required or used by common man across India. Hence, say if it is pulse like tur or urad or a crop like potato or chana. So these are very sensitive pulses because they're used by common man. And hence, there is price sensitivity associated with trading in these commodities. With regards to settlement, now we have made it mandatory that the settlement is mainly through delivery. So somebody who's entering into a contract, if he doesn't offset his position at the time of delivery, he has to, if he has said he will give or he's got into a short position, he has to ensure that he delivers the commodity, whether it is wheat or whether it is the potato or whether it is any other agri commodity. Wherein in equity, it is a demat settlement. If you're buying a share, you will get one share in your demat account, and if you're selling, the share will be debited from your demat account. So, like I said, derivatives are instruments whose value change in response. So an example of a derivative is the futures that I explained earlier with regard to the wheat farmer. So the farmer can also enter into a contract called option. In the option, it is the same process, but the cost to the farmer is only the premium that he's paying to buy the option. An option gives him it gives him a right at the time of harvest. If the price that he's getting on the options platform is not favorable, he's not obliged to sell the commodity. He can just forego the option. So that is the difference between futures and option. In futures, if he's entered into a contract to give the commodity wheat, he has to, at the time of delivery, he has to deliver. Wherein in the case of option, it is an option to him. He can wait, and if he sees that the contract is not favorable to him, he can always forego the option that is available. Forwards and swaps are not available on the Indian platform exchange platforms. Again, this is the derivative contracts. See, either you have exchange traded derivative contracts or we have over-the-counter derivatives. So the main difference is that exchange traded contracts are standardized and they're on the exchange platform, and we have a regulator, SEBI, which oversees the whole process. And we have futures and options. So forwards and swaps are OTC products which are not on the exchange platform. So it is basically a contract between two people, and it is outside the exchange platform, negotiated between two parties, and hence there's no regulator to vet the whole thing. And hence there's always a lot of risk involved. Wherein here we have a clearing corporation to guarantee the trade. That I'll come into it later. I had covered this point of price discovery. So why do we require derivatives? It is like mainly I said price discovery, and the example of the farmer, it is for risk management. He has a risk of his price going down at the time of harvest. So he wishes to get into a contract to lock in the price which is available now, and hence he is able to hedge his price risk. That is the two main features of or main benefit of a derivatives market: price discovery and risk management. Mostly it is farmers or exporters, importers, manufacturers who actually have something to do with the underlying commodity who would hedge. And like I said, we have speculators and arbitrageurs who are the counterparties to such contracts. So the transfer of price risk from the hedger to the speculator or arbitrager who can take such price risk based on their view. I have covered the first 2 points. I'll go to the elimination of counterparty credit risk. When I mean elimination of counterparty credit risk, we have clearing houses, which stands guarantee. So each exchange, whether it is NCDX or whether it is the other exchange, each exchange has an associated clearing house to ensure the financial integrity of its market and facilitate the settlement of trades. So what happens is at the end of each business day, the clearinghouse steps in to break the link between the contract parties. So the clearing corporation will be the buyer to every seller and the seller to every buyer. So when you and I are trading, we are unaware of the counterparty because we are anonymous. We are also anonymous. So the market participant, for the market participant is the clearing house which performs their contract. I mean, there is a process to become a member of the clearing house. What I mean to say is there is elimination of counterparty credit risk. There are, the clearing house handles the margins that secures each contract according to the exchange rules. Trading is largely anonymous, so the market participant can be sure that their contract will be made good by the clearing corporation. And access to all types of market participants. Anybody can get registered with a broker and start trading on the exchange platform. And like I said earlier, these are standardized products, and there is a transparent trading platform because all buyers and sellers are anonymous. Depending on your demand and supply situation, you put in bid or ask price. The main idea of introducing commodity derivatives, especially agri-commodity derivatives, is so that our farmers can benefit from trading on the exchange platform, not by directly trading also. Most of the farmers probably do not trade, and it is through farmer producer organizations that we have trading on the platform. But what we're trying to say is that probably farmers are able to look at the exchange platform and get an idea of the price that is currently available for their commodity. Maybe depending on the price, they can actually decide on which commodity to, produce. Maybe wheat is not having a good enough price and he can go in for a cash crop like soya bean or anything accordingly. So we expect or we wish that the farmers would look at the exchange platform to get an idea about price. And by getting an idea about the price that is available on the exchange platform, the farmer can have a bargaining power in the wholesale market with the trader or the processor or the miller. So that way they can reduce the dominance of the commission agent or the middleman. So if not directly participating in the derivatives market, we are hoping that the farmer will eventually benefit indirectly also from having a commodity derivatives market. These are just examples wherein, like I said earlier, the first picture says that now the wheat farmer has already locked in his prices and now he does not have to worry if the price goes down at the time of harvest. So that is one of the benefits. So these are just price risk management options. So these are the two commodity exchanges. We have National Commodity Derivatives Exchange and Multi-Commodity Exchange of India Limited. And we also have the new entrants like BSE, NSE. We have ISEX also in the commodity platform. The commodities being traded on the exchange, we have, like I said, there are a lot of categories. We have agri, we have non-agri, we have energy, and we also have metals. So these are the non-agri commodity derivatives. Suitability criteria. Again, not all commodities are traded on the exchange platform. So the government has notified around 91 commodities that can be traded on the exchange platform. And even for a commodity, there are certain parameters which are necessary for a commodity to be successfully traded on the exchange platform. So some of these parameters are, say, for example, the commodity should have a reasonable volume and size in supply. If it is a very niche commodity, not many people will have supply and not many people will be interested in trading. So the size of the market is quite important for the commodity to be successfully traded on the exchange platform. Then again, the homogeneity. If it is again, like I said, there is turmeric, and there are many varieties of turmeric. Now, if the turmeric, if the common variety is not traded on the exchange platform, rather if the niche variety is traded, again, the size of the market will be very small, and hence there will be very less participants. So the more standardized the contract or the commodity, the more the participants who would be trading on the exchange platform. Then again, durable and storable commodity. A commodity which is easily perishable will not be very a successful commodity to trade on the exchange platform. Though we have probably storage facilities, cold storage facilities, we would always prefer a commodity which can be easily stored and which is durable for a longer period of time, so that the there is no risk to the participant who's having, or to the farmer who's having the commodity. So these are um, some of the features that are suitable factors that is required for a commodity to be successful on the exchange platform. In terms of risk management, price volatility. If there is no price volatility, then there is no need for a hedging platform. I can give you an example of wheat. Now, for wheat, MSP is always declared by the government, and most of the times the wheat is procured at the MSP. MSP is minimum support price. And hence, most of the farmers do not have a need to hedge on the exchange platform, because they know at the time of harvest that they anyway would be able to sell the wheat at MSP, and hence they don't have much of a price risk. Whereas for certain other products, say soya bean, or maybe even soya bean has MSP, but it is not always procured at MSP. So, or maybe it is always procured above MSP. So what I'm saying is a commodity like soya bean or guar gum, guar seed, so these are very volatile probably, and hence farmer needs to come to the exchange platform to hedge the price risk. So volatility is also a requirement or a factor that we will take into consideration when, or for a commodity to be successful on the exchange platform. If some of the commodities are also traded in the international market, so soya bean. So whatever happens within the international market will also affect the price of the commodity in the Indian market. And hence, in terms of risk management, it is nice to have a commodity which has good correlation with the international market. If there is the second thing in the table is ease of doing business. Here again, if there are interventions from any segment, then there may not be much of interest by participants to trade in the commodity. So if there is lesser the price control or lesser interventions, the more the successful the commodity would be. Key features of a contract specification. So this is important when you're actually going into going for trading on the exchange platform. When you see the contract specification, say you are taking a particular contract like say wheat or soya bean or guar gum, the exchange will come out with a specification. So it will say what is a basis center, what is a variety. So these are things that probably the the terminology would be important for somebody who's trading on the exchange platform. For example, basis center. Basis center is the place where the exchange is going to uh, it's the place where the exchange is having the warehouse and where the delivery is going to happen. It can also, in addition to the basis center, it can also keep additional delivery centers. For example, in the case of say turmeric, that is probably Nizamabad market in Maharashtra and probably basis center, and probably there are additional delivery centers in Karnataka. So these are basis center and additional delivery center of examples. Now basis variety and tenderable variety. So not all variety of turmeric would be allowed to be delivered on the exchange platform. So the exchange might say that Nizamabad turmeric can be delivered. Karnataka or Alapi variety of turmeric can be delivered on the exchange platform. So they will give a tenderable variety which is allowed. Anything which is not satisfying the exchange rules or exchange delivery conditions will be rejected. So that will also be specified. So somebody is going into a contract will have to specifically see what is the quality and what is the variety which is allowed on the exchange platform. Again, trading unit and delivery unit. So maybe the minimum that you have to deliver is say 5 metric tons for wheat or 10. So again, a small farmer may not be able to. So even these things need to be looked into before getting into a contract or before getting into a trade. So delivery unit is the minimum amount that you probably will have to deliver, and trading unit is the is the size wherein you can trade in that and multiples of that. So if 1 metric ton is or 5 metric ton is the delivery or trading unit, you can trade in multiples of that particular metric ton, 5 or multiples of 5. Tick size is the smallest amount by which the price changes of the contract. Additional delivery center is like in addition to the basic center, you can also have additional delivery centers. So these are the places where there are regulated and accredited warehouses of the exchange where the commodity can be stored and kept. And the timing of trading, again, they will mention whether it is 9 to 5 or 9 to 11:30, depending on the exchange. Quality parameters, of course, they will mention. Even if it is turmeric, what kind of moisture content and other things would be specifically mentioned. Delivery specification, right now we have staggered with compulsory delivery. So towards the expiry of the contract, say the contract is expiring in the last day of the month, probably the previous 5 days, you can be in those 5 days, the seller can ask for delivery of the contract and the buyer will have to deliver. So compulsory delivery. So that's why it is staggered. In last 5 days, any of the days, the seller can ask for delivery. Maturity date, again, like I said, the contract will mature on a particular date. Mostly it's a 1-month contract. So if we launch a contract today, it will probably expire in the next month. So there, the maturity date, the due date, all these are mentioned as per the contract specification that is released by the exchange for each commodity. Risk parameters, when you are also getting into a contract, you need to see how much that is limit on open position. So a client cannot get into a contract which is say exceeding 20 metric ton. So there is a limit on the position that you can create. And there is a daily limit on price fluctuation. So the commodity price can fluctuate, say, around 3% in a day. And if it goes beyond 3%, then there is a cooling off period. And then for the next 15 minutes, it will trade at the 3% limit. And then it can be extended to 4 and to 6%. So even the price, there is a daily limit on how the price fluctuates. And when you are trading onto the exchange platform, you have to give an initial margin. Then you have an extreme loss margin. Then you have other special margins, additional margins, depending on the volatility, which will be sought by the exchange as and when there is a requirement. Final settlement price is again by polling of the spot price, which the method will be again in the contract specification as to how the exchange does it. So the final settlement price is when the contract will be settled on the day of expiry. The ecosystem is like this. We have the stock exchange where it's a trading platform, and we have the contracts being traded. I've already mentioned the role of a clearing corporation, which stands in between the buyer and the seller to stand guarantee to the contract. And we have a repository. So, what is the role of a repository? So the repository maintains the records of goods stored in warehouses. So if you are a farmer and you have used or you have kept your produce in the warehouse, which is accredited by the exchange, the repository will create a receipt for you. Nowadays, just an e-receipt, like how you have a demat credit into your account, we have now an e-receipt, which is called ENWR, e-negotiable warehouse receipt. So it is a repository which creates records. So once you store your good, you'll be given a ENWR. Now with this repository, it becomes more safe and transparent because there can be transfer of this ENWR between the users. So if you want to transfer this ENWR to another person, you can transfer. The goods will remain in the warehouse. So there is no duplication of the receipts because it is EN. And then the farmer can pledge this ENWR with the bank. In fact, like I said, you can even transfer and sell this ENWR with the goods remaining in the warehouse. And there is real-time notification to the holder of ENWR and even to the warehouse service provider that so and so is the owner of the of the goods. And hence, and there is also these come under the Warehouse Development Regulatory Authority, and hence there is regulation also. In simple terms, repository is like a depository that we have in the equity market. Warehouse service providers, these are like depository participants. So they are the ones who would be giving you the warehouse receipts, and I mean, they are the ones who are providing the warehouse services, and they come under WDRA, which is a Warehouse Development Regulatory Authority. We also have quality assayers and testing labs. So sometimes when you are giving a product or a commodity to be stored into the warehouse, exchange accredited warehouse, then it needs to undergo quality assaying and testing. So we have people who do this so that we are ensuring to the buyer of the commodity that the product that he's getting is as per the quality norms that is mandated by the exchange. We also have price polling agencies. The futures market is correlated with the spot price, and hence it is important that we have a very fair spot price being disseminated, and this is being disseminated by a polling mechanism wherein there are the spot prices polled from a lot of agencies, and so that we get a very fair price at the end of the day. And only then we can also ensure that we have fair price discovery on the exchange platform. We have farmer producer organizations. So like I said, mostly small farmers probably would not be having the wherewithal to come onto the exchange platform and trade in these contracts, and hence we have farmer producer organizations. These are organizations that aggregate a lot of farmers in a particular area, in a particular or having a particular commodity. By this, what happens is that they have the larger bargain, in the sense they would have a better lot of more information. They have more saying power, so that all the farmers together there, whether they buy their fertilizer, whether they buy their or have their harvest, the produce, everything is on a larger scale, and hence they would be able to better negotiate on the exchange platform. SEBI's recent initiatives, there are many, but then I would probably say we have permitted options in goods. So this is only available in the commodity derivatives market. So in this, earlier we have options on futures. In this, it is options in goods, wherein the options would be on the underlying goods directly. And this is, though we have options on futures, this is in addition to options on futures. So we would say that will be better he can either give or take delivery. It doesn't devolve into the other things are that we have permitted mutual funds and portfolio managers, so that the market is more mature and gets deepened better. We have also integrated commodity and equity broking activities. Trading lot and delivery lot has been aligned, so that you will have the size. If it is 5 metric ton delivery unit, it will also be 5 metric ton trading unit. We also have indices, which are for institutional investors mainly to participate. We have, say, an agri index, so that you can, if it is of 10 commodity agri commodities, so once you get into a contract on the index, you get exposure to 10 agri commodities. These are some of the misconceptions about trading in commodity derivatives. That there is probably it is dominated by speculators, but like I said earlier, while the market is mainly for hedgers, but we need speculators and arbitrageurs to be on the other side, so that to take the price risk and prone to manipulations. But we can assure you that we have all risk management policies in place to ensure that there is no price manipulation, or there is no stock cornering or any such things. And we have enough surveillance mechanisms to ensure that manipulations are not easily done on the exchange platform. The exchange, with regard to quality of delivery, we have enough assaying and testing labs, and we ensure that the quality that is mentioned as per the contract is what is made available to the buyer of the commodity. And for some of the products, there is also a premium and a discount metric. So if a premium commodity is being delivered by the seller, he'll always get a little more premium for the premium good that he's delivering. And again, large traders and investors probably are main participants, but slowly the trend is changing, wherein we have delivery and trading units which are of smaller sizes also. I mean, in the sense we are able to get a smaller participants also to trade on the exchange platform. And FPOs are aggregators where farmer producer organizations are also now coming onto the exchange platform to benefit from the exchange contracts. This is the grievance redressal mechanism. This is it's called Scores. It's an online system where you log in and you lodge a complaint. You can register if you are a new user. You can file your complaints. You can view the status online, and if you are not satisfied, you can also review the complaint. It is an online process, so you would know where it is pending and for how long. What is the process? If some of you are students who are listening to the session, it is mainly for people who are inexperienced. Don't we request that you trade only through a SEBI registered member and do not give money or thinking it is a SEBI registered member. If you have doubts, there are a list of members, brokers are all available on exchange website and on SEBI website. Have a check whether it is a SEBI registered member, only then trade. Then if you're signing on the KYC norms, be sure that you know what you're signing on. If you do not want to give power of attorney, do not give. It is not compulsory. And please ask for a copy of the KYC. You are getting into a trade. At the end of the day, you would be given a contract note on your email if that is what you've asked for, or a physical contract note. And you would also be getting messages from the depositories saying that this is what trade has happened and this is the credit or debit on your account. Please have a look, and if you haven't done any of those transactions, you are requested to revert immediately. There are many a time people do not revert on time. They do not see, they do not ask for contract notes, they do not keep a track, and then after a month or after 2 months, they come to us saying there has been unauthorized trading in the client account, and please, this is not done by me. Then it becomes very difficult to examine the matter. So it is always good if you immediately, if you have done or if you get such messages, to please have a look. The other thing that we would like to say is that it might seem surprising, but we get a lot of complaints wherein people give their trading account password. Please do not share your internet trading account password with anyone. And do not, there are a lot of people who would promise you great returns by trading on the market, whether it is trading in the commodity or whether it is trading in the equity market, wherein returns of exorbitant returns are being promised. Please do not get carried away. It is just not possible for anybody to guarantee you any return. Do not, brokerage, again, it is up to you. You please have an idea. You can ask the broker to share the brokerage sheet so that you have an idea of what the charges that the broker would be accepting or would be keeping. Other than that, register your mobile number, email ID. Not enter into assured returns or any member. Insist on periodical statement of accounts from broker. So these are some of the things that we always try and tell the investors, especially new participants who are coming onto the exchange platform, to be careful. I don't have anything further to say. Anybody who needs any clarifications, any questions, any queries, or Sajak, if you have anything further to add, please do.
Thank you, ma'am. Anyways, like you have covered almost all the aspects of basics of the commodity future market. Like if anyone has questions, then we can answer basis if anyone is having any queries.
I guess there isn't any questions, so I think we'll wrap it up. Yes.
Okay, just once more I'll ask. Is anyone having any questions? Like you can unmute yourself or you can place the question in the chat box. Seems no questions.
Okay, Sajid. Thank you, participants. Thank you. Thank you all. Thank you, Sajid.
Okay, thank you, ma'am. Thank you all for joining and giving your time for this session. Thank you all. Stay safe.
Thank you.